three excellent papers. It will be followed by a general discussion by Marco Pagano, and then at the end there will be again time for questions at the end of the session. The first presenter is Frédéric Vinas, and Frédéric will talk about the cyclical growth of public firms and the COVID crisis. Frédéric, you have 15 minutes.
Thank you very much for the opportunity to present this work here. And so this is a joint work with Benjamin Bureau and Duquerrois. And of course, this work does not represent the views of the Banque de France. So can you see my screen? Yeah, it's okay. Okay, so the starting point of this paper is the lockdown that we experienced in spring 2020 last year. At that time, firms experienced a fall down of their activity, a fall down in sales, and at the same time, firms had to pay back their supplier debt, that debt that they contracted some weeks or some months ago. Supplier's debt is also called trade payables. And you may know that trade payables, supplier's debt, is a significant tool to manage firms' liquidity. To give some figures, in France, trade payables represent more than 500 billion euros. To compare this with other short-term fundings, trade payables, so supplier's debt, is more than 7 times higher than short-term funding from banks. And that significant role of trade payables that is reported for France is also reported for other countries. But despite the significant role of trade credit in firms' liquidity management, trade credit receives little attention in general, and in particular during the COVID-19 crisis. And that's why in this work, we focus our attention on trade credit. So the question we raise in this paper is, to what extent did the trade credit balance of a firm explain its liquidity stress during the lockdown? And to carry out this work, I will briefly present the data we are using. To carry out this work, we rely on a very unique database collected by the Banque de France. This is a database that collects payment default on trade bills. This is a database at high frequency, relatively high frequency, so daily frequency collection of information. It's a database that reports at a firm supplier level any default of a firm. The second database that we are using is a database that collects a balance sheet and financial statement of firms. This is used to compute trade credit balance of a firm, to extract some firm features, to extract information like credit ratings. This is a yearly database. And to give some figures on our database, we have a little bit more than 130,000 firms. And on average, a firm has 20 million sales. And on average, the average firm is a net lender of trade credit. I will come back to that point later on. So first, let's have a look at some stylized fact. So that graph represents the cumulative number of payment default on trade bills. This is scaled by the average number of payment default a week. And this represents the cumulative number of payment default for 3 different years, 2018, 2019, and 2020. The x-axis, this is the week of the year, from the first week until the last week. And the gray shaded area are the 2020 lockdown. So in France, the first lockdown in 2020 started in mid-March until the beginning of May, and the second lockdown started at the very beginning of November. So what you see on this graph is that basically in 2080 or in 2090, the number of payment default, the accumulated number of payment default regularly increase. There is no particular seasonality in that information. But when you look at the information, the payment default on 2020, you see that there is a strong increase in payment default of firms right after the beginning of the lockdown. And then there is a slow decrease in the number of defaults. So what we try to do here is to understand the dynamic of the payment default in 2020. And so what we do is to set up an identification strategy in order to try to explain this. So the framework we are using, it's basically we consider we are in a quasi-natural experiment where all firms are treated, but not with the same intensity because they have different trade credit balance. What we try to explain, our left-hand variable is the payment default of a firm in a given month. So that variables is a dummy set to 1 if a payment default for firm F is reported in month M, otherwise it's 0. And we try to explain that information based on firm trade credit balance. More precisely, this is a 1-year lagged trade credit balance. And we compute the trade credit balance as the difference between trade payables, so supplier's debt, and trade receivable, so cash from FSO claim due by customers. And so what we want to do is to try to explain the payment default over the crisis, thanks to that information, thanks to the trade credit balance. And so what we do, we interact that information with a post dummy that is set to 1 starting from March 2020, and before it is set to 0. We set some controls at firm level, so 1-year lag control, some fixed effect at firm level, and some fixed effect at the industry month level. Before going to the result, I just want to explain the mechanism we have in mind regarding the trade credit and how it could play during a lockdown. So let's consider a firm that is a B2C firms, for example, a retail trader or restaurant. So that firm has essentially customers that pay cash and suppliers that are paid with a delay. And in France, that have to be paid within 60 days. This is by law. So basically, that firm is a net debtor in terms of trade credit. It means the firm has more trade payables, more suppliers' debt than trade receivable coming from customers. And this is a structural feature of those firms. So what we expect during a lockdown is the following one. So the lockdown starts, there is no more customers that come to the restaurant. So there is no more customers, no more sales, no more cash inflow, but the firm has to pay back the supplier's debt. And so this is a source of liquidity stress. No sales that come in and some cash outflows due to the supplier's debt. So this is the source of liquidity stress at the start of the lockdown. Then after the lockdown, when the sanitary restrictions are released, and particularly in the case of France, it was a 2-month lockdown. And so, as you can see, the supplier's debt have to be paid within 60 days. And so what we expect is that at the end of the lockdown, firms have no more trade payables. If they follow that rule, they pay back all suppliers' debt. And on the other side, this is the end of the lockdown, so there are customers that come in, and so there are cash inflows. So the trade credit channel at that time should be a source of cash inflows. And so we expect to see that dynamic, that cyclicality through the trade credit channel. So now let's have a look to the first results. So that table reports the first table. The dependent variable is monthly information on firms on payment default. That information we cover the period January 2019 until July 2020. So we cut our observation in July just in order to avoid the situation where in the last part, in the second semester, we have all government support that is in full power, and so that might pollute what we want to investigate. So we seek to be rather on a rather pure shock, so on the first part of 2020. So what we see here in the first column is that we try to explain firm's payment default with the trade credit balance of the firm. And what we see here is that the trade credit balance on average does not explain a firm's payment default. Then in the second column, we interact that information with a dummy set to 1 for the period March, July. So the crisis period in our case. And what we see is that the coefficient is positive and is significant. So this is what we just explained before as the trade credit channel. When the lockdown start, this is a source of liquidity stress. In the third column, we add our controls, cash holdings divided by scales, leverage, and the size of the firm. And we interact those information with the same dummies and above on the March-July period. And what we get the expected signs in the sense that liquidity helps to face suppliers' debt, and so the higher the liquidity, the lower the probability to make a payment default. The same for the leverage. The higher the leverage, the higher the risk of a payment default. What we see here also is that in period of crisis, the cash was particularly important. The coefficient is even more negative, so it was particularly important to have cash at that time. In the fourth column, what we do is to break down our March-July dummy, and we have so that interaction of the trade credit balance with each month of the time period. So March, April, May, June, July. And what we see is very interesting is that it reports precisely what we did explain before. In March and April, we have positive coefficient, significant coefficient. This is a time period where the trade credit channel was a source of liquidity stress. And so at that time, the higher the trade credit balance prior to the crisis, the higher the probability to make a default. And then when this is the end of the lockdown, when sanitary restriction release, we get the opposite effects, just like we explained. So this is the coefficients start to be negative, and they even start to be significantly negative in July. So this is the reverse effect. The trade credit channel is a source of stress in period of the lockdown, and then it's the other way around. It's a source of cash because there is no more supplier debt to pay, and there are customers that come and pay cash and pay. And just to compare the estimate, so we all variables are scale divided by the standard deviation in order to be able to compare the magnitude. And we see that, for example, in March or April, the coefficient are as high as the leverage. So in the sense that the trade credit channel was a powerful channel in terms of liquidity stress. We give, well, let's don't want to run out of time. So what we want next is to break down that information through different industries. We have an overview of the economy, and we want to know more about what happened for the different industries. So this is exactly the same results, but break down by industry. Here we have so this is still the same dependent variable, and we have one column for each industry. And I first plot those 5 columns. So regarding accommodation and food service, wholesale trade, retail trade, construction, and manufacturing. And we have just simplified the presentation. So we have trade credit with a dummy on the period March-May, and trade credit interacted with a dummy on the period June-July. And so what we see is that for those 5 industries, we have positive and significant coefficient. We also see that first, there is some heterogeneity between those industries. The coefficient are somehow 5 times higher than in retail trade compared to construction or manufacturing. And in retail trades are almost 2 times higher than in accommodation and food service. And the third point, we have this reverse effect that we highlighted just before when the lockdown stops. But that result that we find on those industries is not present for all industries. There are other sectors that do not report such kind of, in the sense that the trade credit channel is not a source of stress. And just to make a link with what I did with at the very beginning, this is particularly so the accommodation and food service and the retail trade that are impacted. It goes with what we expected. So B2C sectors that have a downstream position in the production sales are particularly impacted. Let's give a last result before concluding. So we extend that analysis to go deeper in the compression of the effect. And so just to be brief, we try to focus on firms that are more liquidity constrained. And we have three different ways to capture that. We, in the first two columns, we consider firms that are SMEs versus firms that belong to large group. So if you remember, we had a control variable regarding the size, but now we look at does the firm belong to a large corporate, with the idea that firms that belong to a large corporate could benefit from internal capital management and could soften the liquidity stress from the trade credit channel. So here we have a dummy set to 1 for SMEs, and we see that SMEs were particularly impacted during the lockdown. And when we interact that variable that with the trade credit balance of firms prior to the crisis, we see that indeed the trade credit channel was particularly impacting a source of liquidity stress for SMEs. Just to be brief, in the third and fourth column, we do not choose an information capturing the size of the group or is it a SME group or not, but the credit rating of the firm. And what we see is that we get similar results than in the first column. But here the dummy is the firm a low credit risk or a high credit risk, with the assumption that firm with a low credit risk have more difficulties to get external funding. And
Frederick,
yes,
you are out of time, so if you could conclude.
yeah, sure. So I just directly conclude. So basically what we show is that the trade credit channel is, so in a lockdown, we have a trade credit channel that is at play. It's a liquidity stress at the start of the lockdown, but there is a cyclical effect. After the lockdown, it can generate cash inflows. The trade credit channel do not apply in all industries, but rather in industries that have a downstream position in the production process. And just one word in terms of policy, the feedback for a policymaker, it would be that when you start a lockdown, you should immediately set up a liquidity bridge in order to help firms to face the constraints that come from their suppliers debt. Thank you very much. I'm sorry for those couple of minutes. That too much.
Great, thank you, Frederick. Let's move to our second paper. The next paper will be presented by Felipe Severino from Dartmouth College, and Felipe will tell us a little bit about the cyclical growth of public firms and the COVID crisis.
Perfect, great. So thanks a lot for inviting us to present this paper. It's called The Cyclical Growth of Public Firms and the COVID Crisis. It's co-authored with Katerina Lewolin. She's on the audience. You can see her from Dartmouth. And my name is Felipe Severino, also from Dartmouth. So the motivation of this paper relies on numerous studies in finance and economics that have noticed that large firms perform relatively better during bad times, which we're going to call the size effect. And the flip side of that is that you see that small firms in general perform better on expansion periods. The leading explanation in the literature is that large firms have easier access to external financing, making them more resilient to this negative economic shock. And this is basically the evidence that lends support to these financial accelerator theories, where basically financial constraints are the drivers or amplifiers of business cycles. like the basically seminal papers here are Bernanke and Gettler in 1989 or Gettler and Gildrich in 1994. So what we're going to do in this paper is that we're going to examine the relative performance of small and large firms across the business cycle. Consider alternative explanations for this size effect in addition to financial constraints. And here we're going to focus on public firms, which is in contrast to like previous literature or previous studies that have looked at the overall distribution of private and public firms, in which the specific financial constraint channel is exacerbated. So if you compare like an S&P 500 firm with like 100 employee small firms, you're going to see very big differences in access to credit, which are not present when you subsume your looked into like public firms, which have easier access to public equity financing or other sources of financing. And we're going to use the COVID crisis as a large unexpected shock that's going to allow us to compare how firms reacted to this shock in comparison to like previous recessions in the past. Again, to try to understand the mechanisms driving this size effect. What are we going to find in this paper? We're going to find that since 1974, small public firms grow faster than large firms within the same industry, especially during expansions. However, this size gap has been declining over time and closed during the COVID crisis. This indicates a long-run trend in the performance or in the differential performance between large and small firms, which should be noted, and we believe this is crucial to understand aggregate outcomes. We're going to show that financial constraints do not appear to explain this size effect. And here I'm going to be very clear. It's not that we don't mean that financial constraints are not important in general. We're basically arguing that they don't help to explain the differential performance between large and small firms within the US public firms. And we're going to basically change the focus and point to an alternative hypothesis, which is often overlooked in this like literature as an explanation of the size effect, which is this differential sensitivity of firms to investment opportunities. So very briefly, what is the data that we use? We're basically going to use very standard data, quarterly CompuStat and CRISP data, merged with segment data to allow to understand like diversification issues. We're going to use the definition of recessions from the NVER, and we're going to use the whole time series of CompuStat since 1974 to 2020, which is going to cover about 17,000 firms, a bit short of like 500,000 firm quarters. The average firm in our sample is going to have $11 million in assets, about $1 million in sales, and the average sales growth, which is going to be the measure that we're going to focus on, is about 3% quarterly. So here's the paper in one picture. So this is good for a short presentation, you know. So what we have here is basically, let me explain what we have. We're gonna rank firms into 3 different terciles, okay? Using the lag asset value, and we're gonna assign them to different bins. So the blue bin is the blue line is gonna be the smaller tercile bin. The red line is gonna be the larger tercile bin. And then we're basically plotting like a spline that kind of smooth this time series. What you see here is precisely what I was referring as the small effect. You see small firms during expansion growing more than large firms, and that effect kind of reverts during recessions, okay? We also see this like decreasing trend. You see in the long run, kind of like it seems like kind of firms are converging, and that the COVID recession almost made that conversion come to place, right? Now, I know what you guys are thinking. You're saying, okay, but this is like average. We're not controlling for anything. Is this meaningful at all? So what we're going to do, because we're going to stick with pictures for a while, is that we're going to include an industry times year quarter fixed effects and plot the residuals of that regression. So we're going to have sales growth in the left-hand side. We're going to have fixed effects by industries defined at a 4-digit kind of level, times year quarter fixed effect, and then we're going to plot the residuals. And here the convergency between small and large firms becomes even more more like kind of salient. You see that like overall recessions in the past has been affecting this differential performance in a distinct different way than in the current recessions. Okay, good. So now let's look at the regressions, okay, because we're not going to stick with only pictures. So what is the type of regressions that I'm going to be showing you? We're going to have like a left-hand side variable, in most cases, the sales growth. And then we're going to regress that on basically size, third size, defined in the same way that we define it in the pictures. And we're going to interact this with recession dummies, defined as the MBER timing. We're going to include this like industry times 4-digit fixed effect controls in our baseline specification, but we're going to cluster our observations at the 4-digit industry level. So we're only going to have like basically, we're going to explore variation at the industry level. What you see here, I'm going to basically point out two facts. One, if we look at like this like third side bin here, which is the larger firms, we basically replicate what other studies looking at the wide distribution of firms have showed. You see that larger firms, for instance, in the 80s recession, during expansion periods, grow 2% less than the smaller firms during that same period. That effect also reverts during recessions. So you see a positive effect coming in the recessions. But before we go into that, I want to point out that the trend has been decreasing. So this differential lack of performance during the expansion period has been decreasing over time. So it was 2.3% in the 80s. It was basically 1% just before the COVID pandemic hit. Now, the interesting thing, though, is that recession seems to systematically undo this differential expansion of small firms. And what is more interesting is that, or maybe equally interesting, it depends on your taste, is that the COVID pandemic basically completely undo the differential performance of small firms with respect to large firms previous to the pandemic. Okay. Now, you may be wondering what is driving this. That's precisely what came to our mind when we basically like faced this fact. So we're basically going to augment our baseline specification to include characteristics of the firm lag basically a year. So we're going to include sales growth, change in PPE, book to leverage to understand to what extent this characteristic has an effect on this documented size effect. What you see in column 1, 3, and 5 are basically these regressions augmented. And then what we're going to do in column 2, 4, and 6 is that we're going to include the controls interacted with year times quarter time industry fixed effects. We're going to include the control interacted with year quarter fixed effect. So obviously there, the characteristics drop. And what I want to point out there is that the basic size effect that we documented before for each of these regressions still there. So even when you control very aggressively and non-parametrically, the size effect is still there. Now, what is interesting though is that proxies of financial constraints such as book leverage, cash, and return on asset has basically not effect on the size effect that we document. So controlling for those measures do not diminish the size effect, and it doesn't seem that constrained firms tend to reduce growth during recessions. So now, what are the alternative mechanisms that one could explore and one could entertain based on these facts? Basically, we're going to look at like 3. Diversification. Why? Because diversified firms can reallocate funds and labor internally during a recession, maybe alleviating this constraint. What we're going to do, we use segment data to define basically the amount of diversification within each firm. We control for that very kind of non-parametrically. The effect is on size is still there. You can think about fallen angels of basically firms that have like falling productivity being the ones driving this size effect, or managerial skills. We're going to control for proxies of that. And we also find that kind of the size effect is unaltered. You see that more profitable firms and faster growth firms experience stronger declines in sales growth during recession, which is basically inconsistent with this alternative mechanism. So we're going to turn our heads to this idea of investment opportunities. What is this? The idea here is that smaller firms' growth respond more strongly to positive shocks to investment opportunities. So saying it simple is that basically small firms are more likely to respond to investment opportunities. Consistent with this, in the previous table, you could see that faster growing firms grow relatively faster during expansion. So they react more to kind of like their past performance. And we're gonna do an experiment that kind of get us away from the recessions, okay? So basically we're gonna look at how firms correlate with like cash flow specific shocks to the firms. So what we have here is like basically sales growth returned on firm specific returns. And we're gonna control for like market returns and like industry times quarter fixed effects. So this is basically an idiosyncratic shocks to the firm. And what we find is that basically smaller firms show a stronger correlation with sales growth and investment and firm-specific cash flows news, which suggests that small firms tend to benefit more from growth and choose to grow faster, especially when growth opportunities are more valuable. This evidence points out to these mechanisms, or at least a partial explanation for the size effect. Finally, like one could be concerned about industry structure. So if like basically these big firms are like reacting better during recession, what are the implications for the industry structure? We're gonna look at like market share, measure in two ways, as like the market share of surviving firms and the market share of all firms in the economy. And like the preliminary evidence for the recession and like in the last recession during COVID points out to the like a nuanced picture. So basically we find when we look at the surviving group that the size effect increased the market share of large public firms during recessions, but this effect is counteracted by the entry and exit. So when you include basically the overall composition of the industry, that coefficient disappears. So just to conclude, we basically document a strong but declining size effect within public firms in the US that the size effect is unlikely to be caused. We postulate that the size effect is unlikely to be caused for financial constraints. The heterogeneity in how small and large firms respond to investment opportunity is a potential explanation for this size effect. There's a long trend on the differential performance of small and large firms that tends to a convergency that closed in during the COVID recession. And it seems that this size effect increased market share, but the first is counteracted by the entry and exit of firms. So that's all that I have. Thanks a lot for listening.
We can move to our third paper, which will be presented by Riccardo Sabbatucci. And I think Riccardo will tell us how to outlast the pandemic.
So thanks, the organizer, for having the paper on board, and Marco for discussing that later, and everybody for being here till the last paper of the day. So this is joint work with Davide Pettinuzzi and Alan Timmerman, and it's about how to outlast the pandemic. So let's start. As we all know, unfortunately, the pandemic has hit everybody, companies, individuals, governments, states, and for companies and also household, it was a massive cash flow shock. Okay, and one of the consequences of the pandemics has been a massive increase in cash flow risk and uncertainty about future cash flow dynamics. Okay, and this could have been done due to the virus trajectory, and how governments and central banks would react, how households would start, the trade-off between spending and savings, and how would firm, react to this massive cash flow shock, including how they would fund their, operations, so whether they would have access to credit markets. Overall, what you can probably say about that is that the pandemic duration risk has made the overall firm's capital budgeting decision difficult. Okay. So we all know that the central banks throughout the world really reacted swiftly and massively to this cash flow shock, trying to alleviate that. And we all know that the Federal Reserve issued a bunch of operations to alleviate this issue, this cash flow shock to firms and individuals. Okay, and quoting Jay Powell back in March, that was quoting Mario Draghi back during the financial European crisis. This prolonged support by the Federal Reserve to the economy would last as long as it takes. Okay, and as you are all familiar with yesterday's news, this "as long as it takes" is still going on apparently for a while. Okay, so what we're trying to do in this paper is to look at one subset of these cash flow risk and firms. Okay, so the first question we're trying to answer is how were firms' payout and financing choices affected by the COVID pandemic? Okay, think about dividend payment, buyback, and of course bonds and equity issues. Okay, most in detail, how did the pandemic affect the firm's decision to suspend dividends and buybacks or to raise new bonds and equity? And as we will see in a bit, this is a huge amount of dividend suspension and buyback suspension, and in modern history, these are by far the largest period where a lot of them happen all of a sudden in a short period of time. And the idea here is that firms decided to cap and suspend dividends to preserve short-term capital, while at the same time, as soon as they could, raise external funding to provide longer-term liquidity. Okay, but then the next question we're trying to ask is, okay, we observed the suspension of dividends and these new bond and equity issues, and what firm characteristics were associated with the increased propensity of these corporate actions? Okay, and lastly, the last research question we're trying to address is how did the stock market react to these changes in firms' corporate action? So dividend and buyback policies, but also bond issues and equity issues. Just to give you a motivating example why this is important, this is an article from the Wall Street Journal a few days back, and basically said that Carnival, a lot of companies issue debt, as we all know. Carnival, especially the world's largest cruise operator, had a lot of debt. And Boeing and Delta Airlines also issued quite large amount of debt compared to previous standards. It turns out that they did not only issue debt, but Boeing suspended dividends on March 20. Delta Airlines suspended dividends and also buybacks on March 20 itself. And Carnival, just a few days back later, so on March 31st, suspended both dividends and buybacks. And all three, as the Wall Street Journal article say, they issued bonds and some of them even equity in the following ways. What we're trying to say here is that the timing of this decision is not random. This is the plot showing the price of Carnival, the cruise company, starting from the beginning of the year until the end of the year. Okay, and of course, you know that it's starting falling off when the Diamond Princess, if you recall, back in February, was quarantined out of the coast of Japan, being a cruise operator. But back then, the COVID crisis was not really felt too much in the States. In Europe, was starting to. But of course, the stock market react of Carnival, and then you see that on March 13, there's been the announcement of a national U.S. emergency, and after that, you see that Carnival suspended dividends and buybacks, and then issued a bunch of bonds and a bunch of equity issues, one after the other. Okay, and what we're trying to do is to understand whether this chain of corporate action was somehow following a logic, and I'll discuss this in these slides as contribution number 2. So what we're doing in this paper, as after having highlighted the research question, is basically probably the first paper to look at the joint dynamics. When I say joint dynamics, I mean both the timing and magnitude of firms' capital charges during COVID-19. So we look at dividends, buybacks, bonds, and equity jointly, and look whether any of this action was following a precise structure, let's say. Okay? And we especially follow on changes in corporate payout policies during COVID-19. In other words, on dividend and buyback suspension. Okay. We'd also allow, given this data we have, to test somehow in high frequency version of the pecking order theory. Okay, as I just mentioned, This is the first time in modern history where so many firms, more than 290, something like that, suspended dividends and buybacks in such a short period of time and changed their payout policy. Okay, so this is a perfect testing ground for this kind of test. And most of the paper that, a lot of papers, as Renee was saying, on COVID, usually focus on one or two aspects, mainly bonds or equity. We try to complement this literature by adding dividends and buybacks. And another thing is that, again, as I mentioned for Carnival, several firms undertook a chain of consecutive action. And the question is whether this chain was consistent with what you would normally expect from a pecking order theory style. Lastly, we try to understand the drivers of this firm decision to suspend dividends, buybacks, and issuing in bonds, and look at the market reaction to this. Just to give you a preview of results, around 250 firms suspended dividends and buyback from March till December. That's, as we will see in the next plot, is completely out of range with any history that in modern history we have. And as far as dividends are concerned, we see that US firms saved around 30 billion through dividend suspension and around 55, 56 through dividend cuts. In other words, by just cutting down or suspending dividends, company managed to raise indirectly around $85 billion. Okay, and that's quite a huge number. As far as buybacks are concerned, savings from buyback, although it's a bit more complicated to calculate these numbers, is around 140 billion. Okay, and this is a conservative estimate. It does not take into account cases where companies suspended buybacks but did not disclose, or simply buybacks ran out. Okay. Bonds, some papers have looked at that, but in general, we will see that there's been a huge amount of bond issue, although during the weeks between March and April, the market was only able to only firms which are very stable and safe could issue bonds, and below investment grade firms were shut down, but they were finally allowed basically back in the market somehow in May. Equity almost no issues until April, a few afterwards. What is the interpretation of all this? Trouble firm were basically cutting down on the dividend expense for precautionary motives. Think about hotel chain, think about airlines, while companies that had no really cash flow shock were exploiting the debt market for cheap funding and to lower the cost of capital. Okay. What drives the decision to suspend dividend and buyback? It turns out that size doesn't matter in 2020, and cash on hold doesn't matter, but profitability and revenue does. Okay, so big revenue shock was really driving the decision to suspend dividend and buyback, and together with the market reaction. In other words, firms' short-term stock market returns, both idiosyncratic and total return, and the aggregate volatility, idiosyncratic vol, are strong predictors of all four corporate action: dividend, buyback, suspension, bond issue, and equity issue. Although, and I will mention this towards the end if time allows, the directional causality is unclear. We also are probably the first paper to look at this chain of corporate action to see whether firms were consistent with the pecking order theory, and we do see that this is indeed the case, quite differently from the 2008 crisis, recession. And the event study, firms suspended dividends and buybacks after large negative returns, and they bounced back afterwards. In other words, the market was somehow pushing firms to suspend dividends potentially. And then once the announcement was made, you see this recovery in stock price. Why is dividend signaling during the pandemic important? Well, it's unique, okay? Firms' dividend payment during the pandemic is unique because it allows us to test a trade-off theory for dividend policies. The cost of paying dividends went up, but also the cost of suspension went down. So since I am running quite out of time, I'll just quickly go over to the results. But just citing that, as Renee was saying, there's been a lot of papers on this, mostly on bonds and equity and macroeconomic impact. And of course, by looking at dividend buyback suspension, were also related to previous work by Fan and French and Dober and Prabala. Was very time consuming was collecting this data. It turns out that getting dividends and buyback suspension data at high frequency, meaning daily, it's not an easy task. There's no clear data set where you can get it. So CRISP, which is what most are surprising and corporate finance people will use, only allows you to download daily announcement of positive dividends, not suspension. Capital IQ is pretty messy and is not complete. So we have to go through a bunch of procedure steps to get this data. Okay, and the entire procedure is available on the paper. This is just a simple plot to show you the enormous amount of dividend suspension on top and buyback suspension on the bottom, compared to the Great Recession, but with any other previous history period. Okay, so it's the first time that in such a short term, meaning March, April, and May, pretty much, you see 200 plus firms suspending both dividends and buybacks to most likely preserve short-term cash. This plot shows you what? Shows you how firms' dividend policy changed, okay, over 2020, month by month, with respect to the previous year, month by month, right? So January 2020 over January 2019. And as you can see, most firms starting suspend dividend in end of March, April, May, and then the suspension, of course, this is constant, right? Because if you suspend and you don't reinstate your dividend, that's still a suspension in the Q3 and Q4 dividend. And as far as cuts, you see a substantial number of cuts in May and June, and then especially at the end of the year. If you sum up the bar, that's exactly where the 85 billion comes from. What about this plot? This plot goes into the also related to Felipe paper, somehow financial constraint of good, solid and non-solid firm. As you can see, during the peak of the pandemic, around the third, fourth week of March, non-investment grade firms were completely shut out of the market. Okay, and that's after the Fed introduced, I think, one of the second, funding operation. Then the market was open again for sub-investment grade. And the 2 trillion of bonds issued is exactly what you see summing up the bars. Now, a key, let's say, unique aspect of the paper in the last 2 minutes is that we're able to look at the joint dynamics, right? So here is a weekly plot of all the 4 actions on top of the other every week. Okay, and as you can see, from March 13, you see a bunch of dividend and buyback suspension until sometimes through the end of May, and after that you only see equity and bond issues. Okay, you see there are a lot of questions. I'll get to them at the end. So to conclude quickly, let's just look at some of the drivers of dividend suspension and drivers of buyback suspension. We in the paper compare, of course, to the great financial crisis, the recession, but here what I just want to highlight is that revenue shock and profitability, together with the stock market performance, is what really drives the probability of suspending dividends. So this is a probability regression. And how about buyback suspension? In this case, firm size matters both in 2020 and in the Great Recession. So I mentioned this idea that we are able to look at these joint dynamics of firms' decision, and we have, I think, quite a few instances of cases where firms were consistent in their capital decision with the pecking order theory. In other words, they would first suspend buyback, then dividend, because this is costless pretty much, especially buyback. And then later, if that was not sufficient, they would also issue bond and equity. There are, of course, a bunch of violations. I didn't have time to discuss them today, but they're in the paper. And lastly, what I would like to highlight is the difference in the market reaction to this corporate policy. In this case, I will only show you dividend suspension and buyback suspension. And what you see is that, in other words, the market reacts positively to the news. And this might seem counterfactual, but this is exactly where the causality comes in. Is it the market pushing the firms to suspend, or the firms would have suspended anyway and the market was just anticipating that? It's not clear. And to conclude, because I think I'm running out of time, firms' payout policies were greatly affected by the COVID-19 pandemic, as we all know. Cutting or suspending dividends and buybacks was a way to preserve short-term capital, and was probably seen by the market as the prudent action for firms hit by large revenue shocks, like hotels, airlines. Investment-grade solid firms had no problem issuing large amount of debt, and that usually helped them lower the cost of capital. Revenue growth and profitability, together with stock market performance and volatility, were really relevant drivers for the probability of suspending. And the stock market anticipated changes in firms and dividend buyback policies. That's it. Thank you very much, and looking forward to your comments and Marco's discussion.
Right. Thank you, Riccardo. I think we can move to the general discussion, which will be by Marco Pagano. Greg.
Okay, well, thanks for inviting me to discuss these interesting papers. So let me start with some remarks regarding the distinctive features of the COVID shock that are particularly relevant for corporate finance research. One is that the shock has actually gone through phases, or if you prefer, the true shock, so to speak, comes in the so-called fever period, as it has been labeled by some, which is between late February and late March 2020, when we have this sudden cash flow dry out, where essentially firms, many firms, not all firms, see essentially their cash flow disappearing. And they start scrambling for liquidity, as we saw in the latest paper, or try to save liquidity or scramble for liquidity, issue bonds and so on. Then there is a second period which starts essentially since the Fed intervention, but also since positive news about vaccines started spreading, which is after March 2020. And there we see both a recovery in the bond and stock market, and also after a while, also the first forms of fiscal support in the form of grants, loan guarantees, and so on and so forth. And as we will see, this also has, been witnessed by a strong reversal in securities markets. The second characteristic of the shock is asymmetry. It hits firms and sectors in a very different fashion, depending on their vulnerability to social distancing. So the fact that, in some sectors, people could work from home or could keep working, having very little physical interaction with customers, while in other sectors, for simply technological reasons, this was impossible. Another form of asymmetry is that it hit SMEs much more than large firms. The third characteristic of the shock, which is, I think, relevant for research in corporate finance, is that for quite a while, and maybe even lately, we have not understood how persistent the shock was. So there has been huge uncertainty about, not only the magnitude, but also the persistence of the shock, or even now we're not sure about, virus mutations, whether they're going to go on and be dangerous or not. And as a result of all this uncertainty, we also don't know exactly when and how much will growth resume, not only at the aggregate level, but also within different sectors. And also we don't know how much some work habits or consumption habits have changed permanently and would make a permanent difference to the performance of different sectors. Essentially, this is the work from home, but it's also the online shopping type of question, how persistent this is going to be. And also, we don't know, and we still don't know, what will happen when support programs, especially loan guarantee programs, will be withdrawn. Are we going to experience all the bankruptcies that have been so far avoided? Is this just a postponement, or have we avoided such bankruptcies? And are some sectors going to be permanently scarred? There was this example of Carnival Cruise. Is that the type of firm that will come out of this experience with permanent scars? So just to highlight these points with a couple of graphs drawn from a recent paper in asset pricing that I've been writing with Josef Zechner and Christian Wagner, the left-hand side plot shows the option implied 1-year horizon expected stock returns on companies net of the expected return on the market. And the red line refers to what we call the low resilience firms. So these are firms whose stocks, firms which are in sectors that cannot rely much on work from home, or must have direct interaction with customers and so on. Whereas the green line refers to resilient firms, those that can. And as you can see, during the so-called fever period, which is just in the February-March period, you see that the two lines symmetrically diverging, essentially people demanding very high expected returns on the low resilient firms, and actually requiring a far lower return below the market from the high resilient firms. But then, and here you see the phasing, there is a reversal. A reversal that in the end, if you look at what happens essentially in December of 2020, leads to the total disappearance of this difference. However, if you look more carefully in the cross-section, you see that there are firms such as United Airlines and Royal Continental lines, so companies that have to do with transportation, where not only there is a gigantic increase in the expected return over the market during the fever period, but there is persistence. So essentially you have a kind of scarring effect, in the sense these companies see a permanent increase in their cost of capital net of the required return on the market. Now, this is just to make these 2 points, that this shock has been very asymmetric, but also has gone through phases. And for some firms, but not all the firms has scarring effects. And I think all these 3 points are potentially relevant also for researching corporate finance. Of course, in asset pricing, you can see these things faster, as was mentioned at the beginning by René, but it is surely going to be relevant for research in asset in corporate finance. So, which are the things that are have already been taken on board, so to speak, by corporate finance, and which have been taken on board much less so? The point which is clear, I think, pretty much to all the profession, is that this shock is completely different from that triggered the Great Regression, the Great Recession. That one had its epicenter in the financial markets, in banks, and so on. This one is actually a completely different shock. It is a kind of real shock, and it's highly asymmetric in the ways that I was trying to clarify. So, in fact, if anything, banks have come in this particular crisis as stabilizers because they came in with a very strong capital base, which is very different from what happened in the previous crisis. What are the points that are still not fully taken on board, or not taken on board at all? One is this idea about phasing. As you could see, these papers that we have seen are mostly, or almost completely, focused on the first phase, which is where you get clean identification, because you have this liquidity dry up, and firms have to face this sudden disappearance of their cash flow, or at least some of them. But it would be more and more important as time goes on, of course, to actually take into account the reversal that was evident from those graphs, where they were also evident in Riccardo's latest slides, that also there you have less and less of these corporate policy responses in 2020, but it's going to be more and more important, of course, not just to focus on the fever period, but to take into account the overall responses of firms. What is also has not been fully taken into account is the asymmetry of the shock. So there is a limited recognition of the fact that, in particular, firms with different resilience to social distancing have been differentially affected to this shock. So this shock has not been the same shock for all the firms, but a different shock and in fact, for some firms, it has been a very positive shock, in the sense that they had a huge increase in cash flows, they got many more extra customers, and so on and so forth. And, missing on this point means missing an important identification opportunity. And thirdly, there is issue of persistence. And here we can be, forgiven to some extent. We still know very little about the extent of the reversal and scarring effects, but this is, as René was mentioning, mainly due to lags in accounting data production. Let me now provide some comments specifically on the 3 papers that were presented. The first one, as you saw, it's a paper on the liquidity dry up and brings in the trade credit element for French companies. And this is a really new ingredient, which I had not seen so far in other papers. The second paper focuses on growth and highlights the company size element for large US listed companies. And it is a paper that maybe more tangentially has to do with COVID. And the third paper focuses again on the liquidity dry up, but focuses on the corporate response. In particular, the response in dividend policy, buyback policy, and capital structure policies of firms for US listed companies. So each paper, of course, has a quite different focus. Now, why the paper on trade credit that Vinas presented is really important? It is really important because of the reason that I mentioned at the beginning, that this shock did not have its epicenter in the banking sector, not in the financial sector, but in the real sector. And so it is particularly important to look at trade credit, because trade credit, besides being important, as Vinas pointed out, but the main point is that the trade credit has to do with the credit that gets generated within the real sector. In the interaction between companies. It is, in a way, what funds the supply chain. And it is precisely the supply chain that was disrupted by the shock. So it is particularly important to look at this as a potential amplifier. And the findings are that indeed it acted as an amplifier. Trade debtors that were more levered in terms of trade credit and were more in the downstream sectors were more badly hit. A couple of suggestions to the authors. One is maybe they could do more in exploiting the asymmetric nature of the shock. True, they look at separate sectors, but they could maybe relate more cleanly, even at the firm level, the extent to which they were affected by the shock to their exposure to social distancing, whether their employees could work from home or not. And also, I think one very interesting thing that they could do would be to use trade credit to trace out the financial plumbing of the supply chains within the economy and identify indirect effect, not only the direct, but also the indirect effect of the liquidity dry up. That is, to some extent, probably in their data, what is happening is that you have firms entering distress because their trade debtors have defaulted on them. So they could use their data to study the propagation, the multiplier effect of the dry up. For instance, when imagine a big retail chain defaults on trade credit, then it probably hits a bunch of suppliers. And so the clogging, so to speak, of the plumbing, of the financial plumbing of the industry gets bigger. Now, coming to Severino's paper, as I mentioned, I'm not so sure how relevant this is in particular to the section on firm survival to the COVID shock. The two findings of the paper are that small firms grow more than large ones on average, but the differential shrinks or disappears in recessions and more so in the COVID one. So that's the main reference to the COVID. And this different response in recessions does not appear to arise from financial frictions, leverage, but from larger growth options, investment opportunities, as we heard, although they also show that smaller firms have greater cash flow sensitivity. Now, the reason why I think this is not super relevant for the COVID shock is that the paper focuses on large listed firms in the United States. And so it overlooks that the COVID shock was much larger for smaller and more levered firms. And you could see this much more if you look at small, medium enterprises or even micro enterprises. For instance, there is this paper by Bloom, Fletcher, and Ye, who show that the smallest offline firms experience sales drops of over 40% compared to less than 10% from the largest online firms. So as you see, the magnitude of the shock was much bigger for small firms. And also in a paper based on Italian data, Elena Carletti, myself, and other co-authors show that distress in the COVID, resulting from the COVID shock, is more frequent for small and medium enterprises and for firms with high leverage, higher pre-COVID leverage. So these two ingredients that do not come so strongly, especially the leverage one, in the paper, in fact, in the data are present once you start looking at small and medium enterprises. I also have a concern about the methodology used in the paper. The concern is due to the fact that firm size is not measured at an initial date, but based on firm's asset 1 year before. So small, what you call a small firm or a large firm in the data change at every date. And this introduces to me a potential endogeneity concern, because firms whose sales grow more are likely to also grow in total assets. And so if sales growth and size are serially correlated, you get a feedback from the left-hand side variable to the right-hand side variable. And what is worrying me is that this may mechanically generate the observed convergence of small and large firm growth, because to the extent that high growth small firms gradually move up and gradually turn into large firms, and low growth large firms turn into small firms, actually you get that, you know, over time the two tend to converge, and this could generate one of the two results in the paper. Moreover, if this migration across size deciles, so to speak, is particularly strong during recessions, this could also explain the result that convergence is stronger during recessions. And this could also be amplified by different attrition, in the sense that if in recessions you have greater exit, for instance, due to bankruptcies of small firms, then surviving small firms are larger than before. And so they become more similar to large firms. So again, pushing in the same direction. Let me conclude with some comments about Sabbatucci's paper on corporate cash saving response in the COVID crisis. I think this is a super nice paper. As fantastic job in terms of data collection, and is super careful, and I think also quite novel. I will not repeat the findings. Riccardo did a good job there. I particularly like the fact that these cash saving and cash raising policies are particularly responsive to this liquidity or cash flow dry up. And also they add to this uncertainty shock, essentially the increase in the riskiness of these firms. I also like one finding that he has not been able to mention, what is quite nice, is that firms that had higher cash ratios, so they were more resilient in terms of financial flexibility, were actually able to issue, actually issued relatively more equity than others. So those that already had more cash were able to get more by issuing equity, because this matches with a finding that we have on the asset pricing front, that these firms are considered by financial market as more financially resilient, and therefore could be trusted more in order to, contribute, so to speak, equity financing to them. A couple of suggestions to Riccardo as well. One is that this drop in revenue, as I already mentioned several times, varied greatly depending on firm exposure to social distancing. So one thing that they could do is explore whether these cash preserving strategies were adopted primarily by low resilience firms. That's kind of an easy extension of their paper. Another thing that I would be curious about, maybe once data accumulate, was the endpoint of the process. To what extent are these corporate policies being rolled back later? And are some of these going to have a permanent legacy for firms in terms of scarring? For instance, are some companies such as, say, Continental, United Airlines, or Carnival, or such firms in the airline and hospitality sector, are these going to emerge from this entire business, both the initial shock and then this reversal, with a much more compromised balance sheet in terms of high leverage and so on and so forth? So that these are questions maybe for a future version of the paper.
Thank you, Marco. We are running a little bit out of time. My apologies for that, but I think it was good to give Marco a chance to finish because Frederic, Felipe, and Riccardo will benefit from his comments quite a lot, in my opinion. I think there are no questions in the Q&A box, so my suggestion is that all three presenters would have a chance for a very quick response to Marco's point, and then we will conclude the session.
So thank you very much, Marco, for your feedback, and I carefully note your suggestion to investigate. So I will have a look. Thank you very much again.
Great, thank you, Frederic. Let's go to Felipe.
Yeah, so very quickly, so I want to acknowledge that we're aware of like this idea that small firms were kind of like outside of like these public firms were hit very hard by the pandemic, and as you see, like the other two papers like look at that in detail. We're basically highlighting another role that kind of recessions have on like public firms that has not been like pointed out before. And we don't see it as like a competing hypothesis. It's basically complementary by looking at within public firms how these frictions and how recessions play a role in the dynamic. And also like very quickly that the point about the serial autocorrelation is something that we have looked at, kind of like when you look at the distribution of firms, and it doesn't seem to be something that will drive the results away. Thank you.
Right. Thank you, Felipe. Felipe, let's go to Riccardo.
Yeah, so very quickly, thanks, Marco. Your point one, we can easily check absolutely whether the resilience is linked to the cash flow shock policy change. So that's easily done. And the second point, great point, we started collecting data on dividend restarters and buyback restarters. As you probably read on the news, a lot of firms in 2021 started buybacks program again. So that could be a very interesting avenue for this let's say, time dynamics of corporate payout policy. So that's a good suggestion, and we're looking into it. Thanks.
Great, thank you, Riccardo. I can see that Vikas has his hand up, so if we can handle this quickly, Vikas.
Thank you. Just a short question to Felipe. This is regarding the differential growth for small versus large firms. And the question is, to what extent is the delisting experience for small versus large firms changed over time? And second, to somewhat related to the delisting experience, to what extent has the growth for large firms been a consequence of acquisitions rather than internal capex? And if such a differential effect exists, it might explain both the growth of large firms and also the indirect effect of taking out some of the higher growth small firms from the sample because they were acquired. Just wanted to
yes, that's a great point. Kind of like it's something that is in literally our to-do list in terms of like kind of understanding kind of like the role of like entry and exit and merger and acquisition like waves in explaining what we're seeing. But we believe that it's interesting, this idea that kind of like large and small firms seems to be converging. And that's something that kind of like is changing the landscape of our public firms. So,
good. Thank you, Felipe. I would suggest you can take it offline if there are more details. Let's take the opportunity and thank all the presenters. And I will hand over to Paola for concluding remarks.
Yes, thank you, Jiri. We're really out of time, but I want to say at least 2 words. First of all, in the name of the ECGI, Renee, myself, and Jiri, and Marco, and thank you so much for everyone who has participated, but especially thank you to Margherita and Marco, who did the heavy lifting of discussing so many papers with such great suggestions for the authors. And then the last thing I want to say is that Marco said that it's very uncertain, and I would certainly be a bit daring to make any prediction, but my prediction is that the next conference in June 2022 is going to be in person. So I'm hoping to see all of you in Oxford in 1 year COVID-free. So thank you to everyone. And please continue the discussion offline on questions and see you next year. Thank you.